How much did you earn last month in dividends? How much cash do your mutual funds hold? And where can you easily find all of the DoughRoller podcasts in one place? We'll answer these questions and more on this, the 86th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. So I received an interesting email from a reader, and we emailed back and forth, and it had to do with credit cards and rewards. And actually had a couple different emails from folks, so I'm not going to read them all, but it kind of led me today to the money tip of the day as it relates to credit card rewards. And it's this, there are, of course, the credit card business is highly competitive. They're all clamoring for our attention. They want us to carry their cards. It's obviously a very big and lucrative business. And that's true whether you pay off your balances in full every month. I hope you do, or even if you don't. So a lot of the marketing you'll see cards marketed as you'll earn 2x points or 2x miles per dollar spent. Some of them will say 5 times, 5 points or 5 miles per dollar spent. And the first thing is that it's really important to understand what those rewards apply to. In other words, you earn 2x points or miles on every single purchase, or is it only on certain categories of purchases? A lot of the 5% cards rotate their categories every 3 months, and you actually have to go in and sign up for that 5% offer every quarter, or you don't get it. And even then, it's limited to a certain amount of purchases, typically $1,500. So, if they have 5% at Home Depot, you can't go spend $20,000 on kitchen cabinets and get 5% back. They have a limit. So it's important to understand all of those terms and conditions, and you just got to dig into the website of the card issuer and their terms and conditions to figure it out. But it doesn't stop there, and that's really the tip of the day. It also applies to the value of the points you earn. And I'll give you an example. I carry the Capital One Venture card. It's one of my favorite, and I earn 2 miles for every dollar spent. Sounds great, right? It's 2%. There is a catch, though. Each of those miles, you want it to be worth a penny, right? Most points and miles should be worth 1 penny. So if you're earning 2 miles per dollar spent, you're earning 2 pennies, which is 2%. Except that with the Venture card, you only have miles worth a penny each if you spend them on travel. If you want to use them for other purchases or for other things besides travel, they're only worth half a cent. Now, that's still not a bad deal. It's a 1% card at that point. But if you're expecting a 2% card, there's a limitation. You have to use it for travel. Now, in our case, that works out great. We do enough travel where we can use all of our miles for travel, and it becomes a 2% card, and that's why I carry it and why we like it so much. But I've seen, for example, 5X cards where you earn 5 points, but then you need, say, 12,500 points for a $25 statement credit. Well, that's a 1% card. It's not a bad deal. I would call it sort of standard in the credit card industry, but it's not a 5% card. So the money tip of the day is if you're into the rewards credit cards, great, but make sure you understand exactly how they work and how you can make them work the best for you. Okay, before we get to the main topic, and I'm excited about today's main topic because it's about investing, and that always gets me excited, particularly when we start talking numbers. But before we do that, I wanted to mention one thing. A listener named Paula had emailed me about a number of things. One of the things she asked was, hey, is there a summary page for all of your podcasts? Now, currently, if you go to my site, DoughRoller.net, you will see a navigation link at the top for podcasts. If you go to that navigation link, what it will show you is the most recent podcast, the most recent 10 podcasts. And then at the bottom, if you scroll down, there's a next page, and you have to scroll 10 through a number of pages to see them all. Since we're up to, I guess this is number 86, you've got a total of 9 pages. Now, I'm working on a better page for my podcast, and I will let you know when that's available. But there is one place you can go to see them all in one place, and that's iTunes. And so if you just go to, I've made a redirect link for you to make it easy. If you just go to DoughRoller.net/iTunes, that will redirect you to the page where this podcast resides, and you'll see all the episodes to date, and you can even play them from within this page if you want. Of course, if you have iTunes, you can view them in iTunes and download them that way. And I guess probably the best way is to subscribe to the podcast through iTunes, to get them on your iPhone or iPad or whatever. I think you can do the same thing with an Android device. But that is one place where you can go to see all of the podcasts in one place. As I said, I'm working on the page on my site, actually waiting for a tool to come out that I think will be very handy and make it very easy for you to see them all on my site as well. Okay, the topic for today is Morningstar's Portfolio Monitor. Actually, we're going to cover a number of things. So I mentioned the Portfolio Monitor in yesterday's podcast as a money tool of the day. Today, I kind of want to walk through it for you, including my specific portfolio monitor. I'm going to share everything with you except the bottom line. I don't really talk about the exact amount of our investments. It doesn't really matter, for one. And that was just sort of the line my wife and I decided to draw when I started blogging. But I'll share pretty much everything else because I think, if you're good enough to listen to this podcast, you have a right to know how I invest my money. As I've said many times, it doesn't mean it's the way you should invest your money. That's a decision you have to make. But hopefully you can get some insight and help through this podcast. I hope you do. And so we're going to walk through the Portfolio Monitor. We're also going to walk through the Grow Your Dough Throwdown. What in the world is that? Well, I'll get to it in a little bit. And then I've been running a Lending Club versus Prosper test. Those are P2P lenders where we can either borrow or you can lend money. And I put $1,000 in each at the beginning of the year. And since we're near the middle of the year, I thought it'd be good for an update. So I'm going to walk through how those investments have done. So that's what we got planned for today. Let's get started. Going to start with the Portfolio Monitor. As I mentioned in yesterday's podcast, the Portfolio Monitor is it's a PDF that gets sent to me every month from Morningstar. So Morningstar, you can go to the site and for free get a ton of information. You can register for free and track your portfolio on Morningstar, which is a very handy tool. It's not automated like Personal Capital. And that's why I love Personal Capital and go to it every day. But if you take the time to enter your portfolio into Morningstar, particularly if you invest in mutual funds and ETFs, it's going to give you just a wealth of information about your investments. We're going to talk about some of that in a minute. And that's all free. There is a premium subscription, which I use. And one of the things the premium subscription gets you is this Portfolio Monitor. And I've just started using it, and I love it. Now, the premium membership at Morningstar is not cheap. It's a couple $100 a year. But if you're actively managing your investments, I found it to be worth it. If you go to www.DoughRoller.net/mstar, that's the short URL I've created, DoughRoller.net/mstar, that will redirect you to the Morningstar page where you can look at both options, the free membership and the premium membership. That is an affiliate link. But it gets you access to either one, and you can check it out. I highly recommend the free membership at a minimum. But again, I do want to say this Portfolio Monitor is available for those with a premium membership. And so what do you get? Well, I've put my portfolio, most of my investments, I think all but about 2 or 3% in Morningstar. I've still got a little more work to do. And it spits out this PDF that I get, a very nice-looking PDF that I get at the beginning of each month that gives me an update of my portfolio. And so I'm going to walk through what it shows us, including how I'm doing, for better and worse. I'm going to have a lot of screenshots, though, in the show notes. So I highly recommend you check out the show notes. You'll find those at DoughRoller.net/podcast86. That's podcast 86, and I'll have all of the screenshots. So the first thing it gives you very quickly and very easily is your performance. And it's a very nice graph, and then performance throughout, in this case, for the last year in the graph form. And then it gives you longer periods if you've been tracking your portfolio in Morningstar long enough. I have not been. But for the month of June, my return was 1.59% for the month of June. That underperformed the U.S. market index that they track. That was 2.28%. So I underperformed the U.S. market for last month. Although for the quarter, I outperformed it. I was up 5.18%, and according to the U.S. market index return that Morningstar uses to compare, it was up about 4.5%. Year to date, I'm up, it says 7.04%. That's actually not 100% correct because I said there's a few investments I don't have in here. I need to update it, and I'll do that by next month. But 7.04%, actually I'm beating the market at 6.10%. Now, I don't know what they're using as the market. I assume it's the S&P 500 index, but I'll actually double check that. So that gives you sort of your performance. As I said, it'll give you performance out as long as 10 years if you've tracked your portfolio that long. That's the first thing. The other thing it gives you right at the top is how much in dividends you earned last month that were reinvested. Now, again, this number is not quite right because I don't have all of my portfolio in there, but for me it was about, $5,286.26. I think my actual dividends, I can get the same information in Personal Capital. It was more like $6,000 last month. Now, a couple things about dividends. For the individual stocks that I own, they pay dividends, every quarter. And June can be a big month for that. But obviously, next month, the dividend amount will be much, 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 much lower for me. But I wish I reinvested that amount of dividends every month. The other thing is for mutual funds, oftentimes the big month when they actually distribute the dividends is December. So December will be my biggest month for dividends in any given year, all other things being equal. But I like to see what kind of dividend income I'm earning on a monthly, but even more importantly, on an annual basis. It's something I track. I know what my dividend yield is for my portfolio as a whole. It's something that Morningstar gives you. Mine comes in at around 2.5%. And that would include dividends on stock and stock mutual funds and stock ETFs, as well as interest on bonds and bond mutual funds and the like. So it's something that I think is easy to kind of ignore, and it's probably okay to ignore it, frankly, as long as you're reinvesting it. Just let it compound. But I like to see how it's doing, how it's hopefully improving over the years. And so that's something that you get in this snapshot right at the top on page 2 after the cover page of this PDF. And then what Morningstar does is it gives you your top 5 gainers and your top 5 losers of the month. I only had 4 losers this month. I'm not sure what that means. So my winners, Ford Motor Company. So here's what it lays out. It says the name of your investment, whether it's a stock or a mutual fund, the Morningstar rating. Honestly, I by and large ignore that. The price, the market value of your holding, and then the 1-month return. So Ford was my top gainer, 4.87%. Vanguard Small Cap Value Index was number 2 at 4.3. Small caps have been on a tear lately. Wells Fargo and Company, love that bank. Been reading a lot of their 10Ks, annual reports, deciding whether I want to invest more in Wells Fargo. They were up 4.22%. Vanguard Emerging Markets Stock Index was up 3.04. Emerging markets, these are the kinds of mutual funds. I mean, they can be up 60 or 70% in one year and down 40 or 50% the next. It is a roller coaster ride. And long term, the returns have been excellent, but you've got to be able to stomach the volatility. Anyway, last month, my investment there was up 3.04%. And rounding out the top 5, my good friend, Mr. Apple. Apple Inc. was up 2.77%. Its price is starting to approach its all-time high. I'm not sure if I'm excited about that or a little worried. It was up, of course, they did a 7-for-1 stock split. They were around 700 at a high. They dropped to in the 390s. I bought more when they did. I thought the market was crazy. And it's since gone, right back up. We'll see how they do the rest of this year. I'll be focused on new product launches, which is a big deal, of course, at Apple. And Tim Cook has promised they'll enter new markets. We'll see. But I also want to see how their margins are holding up with their existing product. I'm interested to see how they're doing in China, which is a big potential market for them that they're trying to tap. So, a lot of questions as far as I'm concerned with Apple. I mean, its balance sheet is rock solid, but they're in a challenging industry, and it'll be interesting to see how they perform. Okay, anyone tells you they're winners without telling you they're losers, they ain't being truthful with you. So let me tell you about my losers. Of course, it was only 1-month losers. Verizon Communications. Interestingly, it's a Morningstar rating of 3. I told you I by and large ignore that, except that they also tell you if the rating has changed since last month, and it apparently has. It's gone up. I guess it went from a 2 to a 3. I will probably check that out to see why. As I said, though, I don't put a whole lot of weight in the Morningstar ratings. But the 1-month return, a negative 2.06. Berkshire Hathaway, my Class B shares, down 1.39. Vanguard interim term tax-exempt Admiral shares, which is a long way of saying my muni bond fund, which I keep in my taxable account. You would never want a muni bond fund in a tax-advantaged account. There'd be no purpose in that, I don't think. Anyway, minus 35 basis points, and then rounding out my bottom, my four losers. That's all. I guess all I had was I only had four investments that lost money last month. Vanguard Total Bond Market Index Fund lost a total of 9 basis points. So that's kind of a nice summary of, not all the investments that you have, but the top 5 gainers, top 5 losers. And then rounding out this first page, and this is kind of a graph that I find interesting, is they give you what they think, given your current portfolio, what your balance will be 5, 10, 20, and 30 years from now. And they do it based on the percentage chance that this is what you'll achieve. So they do it based on a 75% chance, 50% chance, and 25% chance. So in other words, the 25% chance would be if the market just did fabulously well the next 30 years. And a 75% chance would mean this is what you'll earn even if the market does not so well over the next 5, 10, 20, and 30 years. And, it's good for retirement planning to give you an idea. Of course, you'll hopefully be contributing more. Hopefully, I'll be contributing more. But it gives you a sense as to where you are. And I look at my numbers, and I'm on track to meet our goals. And again, I don't put, I read all of these projections with a grain of salt. It's one of those things where it's kind of a nice thing to know, but you have to understand its limitations. It's a projection. It's a guess. Maybe it's an educated guess. But it's still a guess. And the other thing you have to keep in mind is inflation is going to eat away at a lot of this. This is not adjusted for inflation. Okay. Now, this is where I think, as we move through this portfolio monitor, where the Morningstar's value really comes in. It looks at the individual investments in each of your mutual funds and ETFs and breaks them down for you. So, for example, I can look at my asset allocation and it breaks it out for me. And for example, cash, 1.42%. Well, wait a minute. I don't invest in cash. I have a savings account. I don't list it in Morningstar. So why do they think I have 1.42% in cash? Well, the answer is it because some of the mutual funds and ETFs that I own hold cash. And they do hold cash. They hold cash for, depends on the fund for different reasons. Sometimes they hold a certain amount of cash so they can pay off investors that want to sell their shares. That would be true for a mutual fund. In some cases, particularly actively managed funds, maybe they hold cash because they're deciding on how to invest it. Now, for me, 1.42% is good in the sense that it's really, really low. I don't want my funds to be in cash. I can open up my own savings account. Thank you very much. I don't need to pay an expense ratio for someone to put my money in cash, right? No, neither do you. But I do understand they have to have some cash on hand, and 1.42% I think is reasonable. If I saw it go up, I don't know what would give me alarm. But if it got much higher, I'd dig in and figure out which fund was holding so much cash and try to understand why. U.S. stocks, 44.05%. Foreign stocks, 31.24%. Bonds, 18.02%. I want that number to come up a little bit, actually. And other, 5.27%. That other is primarily, I think, my investment in DBC, which is a commodities ETF. So that's the first thing it does. It breaks down your asset allocation, but to a very granular level, looking through all of your mutual funds. Then it gives you your equity investment style box and your fixed income style box. Now, these two boxes do two different things. And again, I'll have the show notes. I'll have images of all this. The boxes for the equity show you, first of all, the boxes going from left to right. Imagine a tic-tac-toe box. So if you look at the boxes going left to right, so 3 rows, that tells you the size of your investment. The top row is for large companies. The second row is for medium-sized companies. Third row is for small companies. And what they do is they put a number in each box. It tells you the percentage you have in large, medium, and small. And then for the rows going left to right, the rows going, or columns, going up and down, the far left column would be for value. Think of undervalued companies. The far right would be growth companies. Those are companies that are growing very quickly. And the middle column, they call it core. Think of it more sort of the moderate, the companies that are somewhere between value and growth. And it breaks out all that. So I can look at my this box very quickly, and I add it up, 30, 40, 50, 60. About 67% of my investments are in large companies. 23% are in medium-sized companies, and 10% in small, which is about what I want. I have, in terms of value, core, and growth, I tilt a little bit towards value, not a ton, but I'm weighted a bit towards value, which is just basically my investment philosophy. So I get a quick look at that to see if it's where I want it to be, if I think I need to make any adjustments. With the fixed income style, so fixed income, think bonds primarily, it kind of does the same thing. The rows show you credit quality, high, medium, and low. So high would be like U.S. government bonds, right? Low might be junk bonds, right? And so it's credit quality. Think of it as what's the likelihood that I've given money, bought a bond, and they're going to default. So right now, if you own bonds issued by the Puerto Rican government, they're going to be on the low side because they're struggling. Argentina probably on the low side. Junk bonds on the low side. But if you own U.S. government-backed securities, the credit quality is going to be quite high. And so all of mine are high and medium credit quality. I generally don't invest in a lot. I don't at the moment have a junk bond fund. I have in the past, or other word for that is high yield. I have in the past. I just don't really see a need for it. So I tend to keep my bond investments fairly secure from a credit quality perspective. And then when you look at the columns, it shows you your interest rate sensitivity from limited to moderate to high. And that basically deals with how the duration of your bonds. So if you're investing in 30-year bonds, your interest rate sensitivity will be quite high. And I've explained this in the past, but let me just run over it real quick. It's an important thing to understand with bonds. So let's say a 30-year bond today, I don't know what they pay. Let's just say 3%. That's probably wrong, but we'll just say 3%. And you plump your money down and say, yep, I'm in for 30 years at 3%. Thank you. And then tomorrow the rates go up to 5%. And you think, I don't like that so much. I'm going to sell my bond. And so you put it up for sale, and all these people are like, well, wait a minute. Why should I buy your bond? I don't want to get stuck for 30 years at 3% any more than you do. I can go out and buy a new one for 5%. Tell you what, you want me to buy your 3% bond, that's fine, but you're going to have to sell it to me at a discount. I want you to shave off. If you invested $10,000, I'm not going to pay you $10,000 for that bond. I want to pay you something less to make up for the loss in interest that I'm going to receive. Rather than, if you want to convince me to invest in your 3% bond rather than going out and buying a brand new juicy 5% bond, you gotta discount the price. So you lose money. Now, if you take that same scenario and you bought a 1-year bond, well, yeah, if interest rates jump to 5% next week, you wouldn't be thrilled, but you wouldn't have to suffer for 30 years, right? You'd only have to suffer for 1 year. And guess what? If you wanted to sell that bond to someone, your buyer would only have to suffer for 1 year. So while they still would want a discount, it wouldn't have to be as big because they won't have to suffer for as long. Hope that makes sense. So for me, I tend to keep it at intermediate term. So all of I have no bonds in the short term, which would have limited interest rate sensitivity. And I have no long-term bonds, which would be higher interest rate sensitivity. Mine are right down the middle. Again, that's what I'm comfortable with. I get a little extra yield because they're intermediate, not short, but I reduce the interest rate risk of a long-term bond. Not too hot, not too cold, just right. That's kind of my approach to bond investing. Not saying it's the best, but that's what I do. And I can look at this handy PDF that Morningstar sends me and say, yep, I'm right on track with what I want. Now, moving right along, sector weighting. They go through all the various industries. Think of consumer cyclical, financial services, real estate, communications, energy, and industrials, technology, consumer defense, healthcare, utilities. And they tell you that what they do is kind of nice. They compare your portfolio. For example, I have in, financial services, I have 25.05% of my portfolio in financial services. The S&P 500, if I were to just invest in an S&P 500 index, I'd have more like 15%. So I'm overweighted in financial services. Why? Probably because of my investment in Wells Fargo. That's probably what's overweighting me. Although as I look at the numbers, I think my investment in Wells Fargo is not quite enough to overweight me by 10%. So I'm not sure how Berkshire Hathaway's sliced out. Maybe it's got some financial service. Well, it does. Of course it does. Because one, for starters, it invests in Wells Fargo. And it also invests in American Express, which I'm not sure if that's considered financial services, but I would assume it is. So they have stock in American Express. And so, yeah, I'm probably overweighted because of those two investments is my guess. But in any event, you can look at your portfolio, compare it to the S&P 500 in terms of how your portfolio is weighted by sector weighting. And then you can also see your returns in each sector for the month and compare it to the S&P 500. Very nice. And they show you a chart of your 1 month returns. Very easy to quickly look and assess your portfolio that way. And then statistics, they call it. I love this part. So they use a forward PE. I'm not a fan of forward PE. So let me just run through this quickly. So price to earnings ratio, right? It's the price of a stock divided by its earnings per share. Now, the price is, well, it's the price, right? Whatever it's trading at today. The earnings, though, what are the earnings? Well, do you use the last 12 months of earnings? That's what I would use. They call it TTM, trailing 12 months. That, to me, is what you should use. That's what happened. We know that. It's not a guess. It's history, right? But when people say a forward PE, what they're saying is, we're taking what the company is projected to earn over the next year, and we're using those earnings. Not my favorite way to do it, but as long as you know how they're calculating it, and if you're comparing PEs to PEs, just make sure you're consistent. There's other ways. The Shiller PE, Shiller takes the earnings over the last 10 years, adjusts it for inflation to bring it up to today's dollars, and then calculates a PE off of that. That's currently at 25. I think that has some value. People seem to love that approach. I'm not convinced that it's necessarily any better than any other approach. But the point here is you need to understand there isn't just one PE ratio. There's many ways to calculate it. So I'm at 15.00, which is 88 basis points better, meaning lower than the S&P 500. I like that. I prefer a lower PE if possible. My price to book ratio, 1.7. In other words, the price of the stock divided by the company's book value, assets minus liabilities, or tangible assets sometimes minus liabilities, the company's net worth. My return on assets is 15. It's 15. I wish it were 15. 5.67. That's 70 basis points better than the S&P 500. Return on assets is simply the income being generated by a company divided by its assets. And then you can calculate that for the S&P 500, all of those companies on a weighted basis. And then return on equity, again, it's not similar, but ROA and ROE, you see them quoted together, return on assets, return on equities. Return on equities takes the income of a company and divides it by its equity, the equity, so assets minus liabilities. The idea there is what kind of return is the investor's capital earning? Higher the better, right? So mine's 16.02. And that's something that I really focus on significantly when I'm evaluating individual stocks. I want to know what's the return on equity, how consistent is it, how's it looked over the last 10 years, how does it compare to competitors? If it's better, why is it better? Is it sustainable? All those sorts of things. My dividend yield of my portfolio is 2.17. That's my dividend yield for my portfolio. So that's reasonable. And so it breaks out all of that data. Then, this is another great thing. I just love this report. Fees and expenses. The average mutual fund expense ratio for my investments, 21 basis points. Now, that's average mutual fund expense ratio. That would not be my overall expense ratio because that would exclude stocks which don't have an expense ratio. So my actual weighted average expense ratio will be lower than 21 basis points. I think it's 17, something like that. It gives me my estimated mutual fund expenses, an actual dollar number. And boy, that's a good thing to see because sometimes that gets lost on us. It's a big number. Even at 21 basis points, I look at that number and I think, boy, I want to get that lower. So I'll be looking at my mutual funds to see if I can reduce the costs. I already know which ones are higher, and I have reasons for having them. But the lower, the better. I interviewed a listener named Stephanie. She'll be on a future podcast in about a week. And she told in the interview, she mentioned that what her expense ratio was. I won't tell you what it was. You can listen to the interview. But I'll tell you this. She beats me. It's lower than 21 basis points, and good for her. Regional exposures, and then I can see what parts of the country of the world I'm invested in. North America, 60%. Latin America, only 3%. Seems kind of low to me. United Kingdom, 4.6%. Europe, developed, 10.68%. Emerging markets, 1.5%. 5%. It goes on down, and it shows the breakout. I'm actually trying to move a little more into international than what I have right now. Part of the reason my exposure appears, let me say this, although it says my North American exposure is 60%, 59.36, that's a little, you have to understand how that works. So I invest in Ford, Apple, Wells Fargo, Berkshire. These are all would go in the U.S. North America bucket, but they do business all over the world. The exposure these companies have to world markets is phenomenal. And so, you got to kind of, when you look at these regional exposure numbers, you got to kind of keep that in mind. So I'm more diversified geographically than these numbers might suggest. Okay. Then what you get, it just keeps going. The good stuff, the goodness just keeps on going. Then I get a breakout of every single investment in my portfolio, the ticker, the Morningstar rating, any change in rating. I mentioned Verizon's up 1 star for what that's worth. The percent of assets that I have in that investment. And I really focus on that with individual stocks. Like my single biggest investment in an individual stock is Berkshire Hathaway. 6.75% of my portfolio is in Berkshire Hathaway. And then, of course, it gives you the holding value as of June 30, and then your returns: 1 month, 3 month, 1 year, 3 year, and 5 year. Now, again, I don't have 1, 3, and 5 years filled in yet because I haven't, with the exception of Apple, I haven't tracked my investments going back that far. So, but a great snapshot of all your investments all in one place. Then what you get, and I haven't even gone through and read all this yet, they give you a very detailed summary of every single investment, kind of like an analyst's report, if you will, of every single investment as seen through the eyes of an analyst at Morningstar. And I'll print this out and I'll read them all. I'll read every single one of them. And it's a great way to kind of, keep an eye on your investments and see what they're doing. It includes both mutual funds, ETFs, and Berkshire Hathaway. I'm looking at it now. All my other individual stocks are in here. It's great information. Take some time to read through it, but it's worth doing. Sometimes it's a PDF. I'll just pop it up on my iPad and read through it over the month. So that is the report in a nutshell. If you're a premium member already, there is absolutely no reason you should not be doing this. It is a phenomenal tool. And even if you're not, if you sign up, I would highly recommend that you get it. If you want just the free Morningstar account, I think that's a no-brainer. The information you can get is fantastic. Again, if you go to DoughRoller.net/mstar, that's my affiliate link. It'll redirect you to Morningstar. As I mentioned, I use Personal Capital on a day-to-day basis because it's automatic. I just link my accounts, and that to me is great for a higher level overview of your investments. Morningstar's really when you're ready to roll up your sleeves and get your hands dirty and really dive into the details. But you can check out Personal Capital. Again, this is an affiliate link, DoughRoller.net/PC, one of my all-time favorite tools. Okay, so let me tell you, before we close out the podcast, I want to talk to you about the Grow Your Dough Throwdown. And you can thank Jeff Rose, my good friend Jeff Rose at Good Financial Sense, for the name of this contest. We're going to talk about that, and then my Lending Club versus Prosper test experiment. So what's your Grow Your Dough Throwdown? So a bunch of us personal finance bloggers got together, and we decided we're each going to invest $1,000 and in whatever we want. We're going to open up a brokerage account, invest $1,000, and may the best investor win. And until this month, I was in first place. Just crushing everybody. All right, well, maybe I wasn't crushing everybody, but I was in first place. And I think I'm in second place now. And I hope my plan is to have the numbers up on the show notes. I don't know if every blogger has reported their numbers, but I think Phil, PTmoney.com, my good friend Phil Taylor, I think he's in first place. He passed me by. I don't know what investments he has, but so here's the deal. I started with $1,000, and I opened up my brokerage account at Options Express, and I did it because they have a $100 bonus. You have to do a few trades, and you get $100 in your account, and you can check out that offer at DoughRoller.net/Options Express 100. It's options. It's spelled OPTIONS X PRESS 100. There's no E in there. Options Express 100. That is an affiliate link, but I opened it up there because for the longest time I had an account at Scottrade. I love Scottrade. I opened up my SEP IRA there. They have offices just about everywhere. They're terrific. You can check them out at DoughRoller.net/ScottTradeDR, and that's an affiliate link. But I wanted to try something new for this Grow Your Dough Throwdown, so I did Options Express. And so my account value is currently $1,326.10. However, $100 of that is this bonus, which I'm going to pull out of there. I'm not going to count that. So I'm at $1,226.10. That's not bad. Half a year, I've made over 20% return so far. So I'm feeling pretty good. So what did I invest in? Well, I bought what started out as one share of Apple because it was trading at $500 then. It's now 7.01 shares. It's been a great stock for me this year. I got 8 shares of AT&T. That's now 8.1 because of dividends. And I bought 1 share of Tesla Motors. So my view of these stocks, I love Apple. I think it's a good investment. I think AT&T is a sound investment, has a nice yield. Tesla Motors is just, it's a gamble. I love the company, but as an investment, I would never put any significant amount of money in it. I bought 1 share for this Grow Your Dough Throwdown just for fun. I like following the company, but I think it's got great potential. It could end up being a killer company and a great investment down the road. There's just too many unknowns. It's an impossible company to value. And if you can't value something, it's at least within some kind of reasonable range, you have no idea if it's a good investment or not. So I would never put any significant amount of money in Tesla, as much as I love the company and am rooting for it. But I bought 1 share at $199. It's now trading at $220.05. So there you go. Made $21.05 on 1 share so far. So that was my investment for this competition. As I said, I was leading the pack, and I think Phil has surpassed me. I'm going to get all of the returns from all of the different bloggers who are in this competition, and I'll list them in the show notes, and with links to any updates they have on their blogs. And to me, this is just pure entertainment. That's all it is. It doesn't tell you who's a good investor, who's a bad investor. There's no way 6 months worth of returns, that doesn't tell you anything. 1 year doesn't tell you anything. 40 years, that tells you something. This is pure entertainment, and please read it as such. But it's been a lot of fun, and it's caused me to look at some companies I didn't otherwise, look at before, AT&T and Tesla, and just kind of a fun way to see how other folks, other bloggers are investing. And so there you go. That's the Grow Your Dough Throwdown update. Now, the last thing is Lending Club and Prosper. As you probably know, these are person-to-person or P2P lenders. So the idea is they think of it as like the eBay of lending. They bring lenders and borrowers together. If you want to invest, you can be a lender. If you need some money, maybe you want to consolidate some debts, hopefully, rather than going into more debt, right? You can borrow. And I like them both. I probably prefer, as an investor, I've never borrowed from either one. As an investor, I think I prefer Lending Club. I just like the interface. I've got it set up to automate the investment now. I don't have to do anything. When enough available cash comes in as people pay their loans back, right? My cash balance in my Lending Club and Prosper accounts increase. At Lending Club, when it hits $25, which is the minimum investment, it just automatically finds a new note to invest in based on the criteria that I've set up, and does it automatically. Sends me an email, which I immediately delete, don't even think about. And so I started with $1,000. I'm at $1,043.62. So I'm up 4.36% for the year, for 6 months. Now, is that good or bad? Well, a lot of people like to compare P2P lending with savings accounts. You're only getting 90 basis points on a savings account, so this is better. A silly comparison. Lending Club is far, far riskier than there's virtually no risk in a savings account, right? They're FDIC insured. People will default on loans with Lending Club and Prosper. It is much, much riskier than, it's not even, in fact, saying that it's riskier than a savings account understates the increased risk of a Lending Club. All right. That's like saying skydiving is riskier than just sitting on your couch watching TV. No, it's a lot riskier. You don't even compare them. But it can be, I think, a good and fun investment. As you can tell, I don't put a lot of money in either one. I know some people who do. And if you diversify enough, you can make a good return, I think. At least I have. And so that's my Lending Club account. It's at $1,043.62. Prosper a little lower, $1,027 and a nickel. So 2.7%, still not bad. So that's the competition, though. I've invested in notes on both platforms with similar risk profiles. My returns in the past have been a lot higher, actually. There were times when I was well above 10%. But what I did for this experiment was kind of remove everything, kind of start from a blank slate, invest $1,000 in each. So I'm kind of just starting over, really. And that's where I am. So you can check them out both. DoughRoller.net/lending club will redirect you to Lending Club. DoughRoller.net/go/prosper. I know that's a mouthful. That will redirect you to Prosper. I'll have links to all of these in the show notes, which you can check out. Those are affiliate links. So there you go. That's the update for the Prosper and Lending Club experiment. That's the update for the Grow Your Dough Throwdown. And most importantly, I've introduced you to the Morningstar Portfolio Monitor, an excellent resource. I love getting it. Kudos to Morningstar for putting that together. The thing is, if it's all you look at every month, it's a great way to look at where you stand, where your investments are, how they're comparing to the market, where your exposure is geographically, where your exposure is based on the industry, where your exposure is, interest rate exposure is for your bonds. You can. I read through it cover to cover. You could easily flip through it in 5 to 10 minutes and learn everything you really need to know to keep an eye on your investments. So a great tool, highly recommend it. But hey, appreciate you tuning in today. If you have any questions at all, don't hesitate to email me, dr@DoughRoller.net. And hey, if you haven't, I'd appreciate it if you have the time to head on over to iTunes, leave a review of the podcast. Let me know what you think of the podcast. I read those ratings and reviews. They're very helpful to me to see what I'm doing right, what I can improve on. I'd be grateful if you took a few minutes to do that for me. Thank you very much. Hey, have a great day. And until next time, remember, the best thing money can buy is financial freedom.